In this session, let us understand how bankers are analyzing fund flow statement. Fund flow statement is a great tool because using fund flow statement, you can know what are the long-term sources available in the business, what are the long-term uses, and whether the business is making any surplus or deficit, and if it is surplus, how the surplus were used, if it is deficit, how the deficit was funded. That can be known from fund flow statement, which may not be apparently visible in the financial statement, that is your balance sheet or your profit and loss statement. Now, what is sources in fund flow statement? When we say sources, it basically means long-term sources. Okay, so what are the ways, or from what sources and all you will get long-term funds? If you are investing money, let's say you are the equity shareholder. Okay, if you are the equity shareholder, then this equity shareholder's money is a long-term money. If you are preference shareholder, then again it is long-term money. So what I mean here is equity capital. Similarly, the preference share capital. All these are long-term sources. Similarly, if I raise term loan, it is a long-term source. If I raise debenture, it is a long-term source. So these are all the sources which are long-term in nature. What about the profits? Yes, profits are also long-term source. Now, whether sources will appear only on the liability side of the balance sheet, because the balance sheet is simply a statement which shows you the sources of funds and use of funds. That's all. And all liabilities are called as sources of funds and all assets are called as uses of funds. But that convention is not applicable here. Here I said sources can be from profits, debenture, term loan, preference, equity. These are fundamentally liabilities, but I can also have sources from sale of long-term assets. It can be a sale of fixed asset, it can be a sale of long-term investment. So understand, sources, that is long-term sources for the business, can be from various aspects like this. And when I say profit, I mean the cash profit. It means I have to adjust for non-cash items which were considered while arriving at the profit. Okay, so that's all captured in this format. If you notice here, you have various sources, and in that the first two items, that is net profit after tax and depreciation, they basically take care of your cash profit. Then if there is any increase in capital, that is captured here. If there is any increase in term loans, that is captured here. If there is any sale of asset, which is a source, that has been captured. If there is any sale of other non-current asset, that is captured here, and any other sources will be captured here. It is a CMA where the sales are already linked, so automatically it will go to income statement, that is profit and loss, to get your cash profit. It will pick up profit after tax and it will add depreciation, so you get to know what is cash profit. It will automatically go to capital in your balance sheet. It will compare the current year capital with previous year capital. If your current year capital is greater than previous year capital, then there is inflow of equity that will be captured here. Similarly, term loans, it will compare your current year term loan with previous year term loan. If there is any movement, if that amount is increasing, that will be captured as a source. And with regard to fixed asset, it will compare the current year fixed asset with previous year fixed asset. If the fixed assets has come down, that indicates there is a sale. Like that, each and every item are compared with current year and previous year to identify whether there is any source or not. Okay, in that way all sources are captured and they are totaled here. Next, fund flow statement will go and grab all the uses. What are the uses? Let us understand first. Uses can be purchase of asset, basically long-term asset. So it can be purchase of fixed assets, or it can be investments, long-term investments. So I'll say purchase of long-term investments. Okay, but don't lock yourself saying that uses can be only with regard to assets. If you are repaying liability, that is also a use. Let's say repayment of term loan, it's a use. Redemption of debenture, it's an use, right? Similarly, buyback of shares, it's a use. Payment of dividend, it's a use, a long-term use. When equity comes in and when we accept that as long-term source, payment of dividend should be viewed as long-term use. Now, we accepted profits as long-term source. If profits is a long-term source, then loss should be considered as long-term use, right? So these are all the possible uses. Let's see what our format has. Our format will first capture the net loss, if any, so that is considered as the major use. Second, if the term loans are repaid, it will compare the current year and previous year position. If the term loan is coming down, it will be captured as repayment. Then it will compare the fixed assets. If fixed assets are increasing, it is a purchase, so it is a use. It will compare non-current assets. It will check whether there is any dividend payment. It will check for other movements. So all uses are captured. So you will have total uses over here. Let me just highlight them. You will have total uses over here. Your total sources are over here. And now, just for understanding, let me compare. In 2013, what is the total source? 14.95. What are the total uses? It is 11.72. Let's say figures are in crores. So your sources are 14.95, users are 11.72. It means in the summary I am going to capture there is a long-term surplus. And how is that? It is 14.95 minus 11.72 and it works out to 3.23. This is something which we can feel happy about, because you had so much of long-term source, you did not spend everything, you had spent only 11.72 and you had something balance, surplus 3.23. But look at next year 2014, long-term sources are 10.9, users are 16.71. Why it is so huge? Because that company was suffering a loss 15.54, and because of that it has become such a big number. Now what is the impact? The source is only 10.9 whereas use is 16.71. It means they are landing in a deficit of 5.81. They are landing in a deficit of 5.81. Let me just make it little more readable. Yeah. So now the question is, from where this 5.81 was funded? Who funded this 5.81? Let us understand. First, let's focus on 2013, then I'll come to this suspense. In 2013, there was a surplus of 3.23. How this surplus was used? Let us understand. If you notice, in 2013, you have some figure in increase or decrease in current asset. Actually, positive number means increase in current asset. It means current asset build up increased. It demanded some investment to the extent of 5.17 crore. And there is a increase in current liability also. So when your current asset increased by 5.17, there is a simultaneous increase, not to the equivalent extent, but to the extent of 1.84. So your current asset of 5.17 is funded by current liability of 1.84. It means balance 3.33 still requires funding, where in current assets. Who is going to fund this? It is going to be funded by this long-term surplus. Long-term surplus is 3.23. Requirement for your working capital, current asset minus current liability, is 3.33. So this entire 3.23 will be used here. So still there is a shortage. There is a net deficit. How much? 0.1. And this net deficit is funded from increase in bank borrowings. This is something manageable, right? This is something manageable, and this is something which every business will have. there will be some increased requirement in working capital, and that is being met out of long-term surplus. That is the ideal scenario actually. Here if you notice, current asset increases 5.17, current liability is 1.84, so working capital requirement is 3.33, and that is beautifully met from long-term sources, and still there was some shortage. That shortage was met from bank borrowings. But let us see 2014. Let's understand what is happening in 2014. Their sources was 10.9, uses is 16.71. It means there was a shortage of 5.81 crore. So from where this 5.81 was met, let us understand. Look at here, current assets has come down. Why current asset is coming down? It may be on account of various reasons. If last year you had too much of receivables and in the current year current asset had come down because of reduction in receivable, you should be happy. Because money is coming in, liquidity is pumped back into the business. But you should be equally concerned why there is no increase in receivables in the current year. It means no sales is made. So that is the other impact. Okay, so in 2014, current asset has come down by 10.6. It means funds have come into the business to the extent of 10.6. But what happened to current liability? Current liability also has come down by 5.14. It means current liability coming down means payments, outflows. So you realized a 10.6 with a reduction of current asset, but you have to pay 5.14 for repaying your current liability. So what is the net money available? It is 5.46. Now this 5.46 is used for funding the long-term deficit of 5.81. What is the money available? 5.46. From where? From working capital. Reduction in working capital. Right? This is used for funding the deficit in long-term sources. Now, despite this, there is a shortage of 0.35 crore. Or it is not shortage. Let us understand it correctly. Look at here. The money realized is 10.6. What is paid is 5.14. The gap is 5.46. This 5.46 was adjusted against the deficit of 5.81. So there was a shortage of 0.35 crore, and that shortage is met from increase in bank borrowings. So this communicates there is something really wrong in this company. Okay, but somehow they have managed the show. They were able to collect money. Okay, they were able to pay off their short-term creditors, and they had some surplus. That surplus was adjusted here, but the future of this company is little bleak. Now, to make this fund flow little more interesting, what I'll do, I'll say net loss is 0. Okay, and what was the amount? 15.54. Net loss is 0, and company has purchased an asset of 15.54 crore. And let me say their profit is something like a very minimum profit like 0.5. Okay, now let us try to understand the scenario. And this is what bankers will be very keenly looking for. Look at here. In 2014, their total sources are 11.4 crore. Their total uses are 16.71 crore. Source is only 11.4. Uses are 16.7. It means they have a shortage of 5.31 on long-term front. Now, what is the problem? Long-term source is only 11.4. Long-term uses are 16.71. They have acquired the asset with this shortage, but without money they cannot acquire this, right? So they have already funded the shortage. That is the understanding. They have already funded the shortage, that is 5.31. From where they have funded? Now I'm going to tweak this a little. Okay, from where they have funded, I made some changes in these numbers. Okay, follow closely. This company has a deficit of 5.31 crore. And here if you notice the increase or decrease in current assets, there is an increase in current asset. That is, some investments were made in current asset to the extent of 2 crore. So there is a demand for money. Okay, and at the same time there is a decrease in current liability. It means they have paid off 5.14 crore to sundry creditors or any other current liability. So on working capital front, 7.14 crore is going out. That is 2 crore for current asset, 5.14 crore for current liability, 7.14 crore money is going out. Money is not coming in, it is going out. And already money has gone out to the extent of 5.31 crore in purchasing this kind of assets. So what is the total money that is going out? This 5.31 plus 7.14. So totally 12.45 crore had gone out. Now from where this 12.45 crore was funded? It was funded by increase in bank borrowings. What is the problem here? There is a severe problem for this banker. Why? Banker had given 12.45 crore for working capital purpose. Here when we say bank borrowings, it is basically cash credit. The bank borrowings that is captured in fund flow statement is basically cash credit, working capital facility. So banker had given 12.45 crore for working capital purposes, but if you go deeper how this 12.45 crore was used, it was used to an extent of 7.14 crore for working capital purpose, and the dangerous part is 5.31 crore had gone for acquiring assets. What assets? These kind of fixed assets. Now what is the problem here? The problem is, just imagine this company gets stuck in working capital process. Okay, let's say some payments which are supposed to come on time is not coming. So what will happen? The working capital facility of this company will get affected. What is their bank borrowing now? It is 12.45 crore. So on this 12.45 crore, month on month they have to pay interest. They have to provide stock statement. They have to show what is their debtors, what is their inventory, and those will not support this level of borrowings because they don't have that much of inventory or debtors for 12.45 crore. Because out of 12.45 crore, only 7 crore had gone for funding the working capital. Remaining 5.31 crore had gone for long-term purposes. So this company will eventually get into trouble. And what the bank will do? The bank will ask the company to reduce the outstandings in CC, in cash credit, and the company will try to reduce, but it cannot. Why? Because the money was not invested in working capital, it was invested in fixed asset. The money invested in fixed asset will not come back within short cycle. It will take a longer and longer period. So what will happen? The banker will be pressing for payments. Come and reduce your CC. Your stock statement is not supporting 12.45 crore. Reduce the CC. So pressure will build up. The company will find itself in very, very difficult situation because whatever money it had, sizable portion gone for acquiring fixed assets. Another portion for working capital. Working capital now got struck because one major portion is locked in fixed asset. So working capital rotation is not happening perfectly. So bank will wait for 30 days, 60 days, 90 days. Then beyond that, bank will say your drawings or your outstanding in CC, that is this 12.45 crore, is not matching with your drawing power. Your account has become NPA, non-performing asset. So we are going to enforce the security, sell all the assets. Then we are going to settle or close your loan. That's all. That is the end of the business. So fund flow statement will tell you that or will reveal these kinds of dangers that can happen for a company. It is this figure is sufficient to indicate that something is wrong. Okay, this company is going to be in serious trouble. Okay, now if this deficit had been funded within this part, okay, by inflow in current assets, then it would have been different. But what happened is this was adjusted by increase in bank borrowing. Bank borrowing is a short-term facility, whereas this deficit is a long-term adjustment. Short-term source and long-term use will never work. Okay, so those kind of dangers are revealed by fund flow statement. So understand, fund flow statement will tell you the sources, what are the uses, it will reveal whether you have surplus or deficit. If you have surplus, you can be happy about it. If you have deficit, you have to go back how that deficit was funded. In 2013, they had surplus, okay, and something was happening. In 2014 also, they had deficit, but the earlier working, in the earlier working, before I change the numbers, that deficit was managed within current asset and current liability. Well and good. But in this example, this deficit is not managed within current asset and current liability. It had been shifted to bank borrowings. So this 12.45 crore bank borrowing was not actually for, not entirely for working capital purposes. One portion went for fixed asset, which is called as diversion of short-term funds for long-term purposes, which is legally prohibited. If you take any bank sanction letter, there will be a specific condition saying cash credit amount should not be used for long-term purposes like acquiring fixed assets or investment elsewhere. It should be used only for working capital purposes. Okay, so those kind of serious issues are revealed by this fund flow statement.